January 2019. A 30-second Gillette ad torched nearly $9 billion in value overnight. Customers revolted. Headlines screamed, "Disaster." But Warren Buffett had not owned a share in years. He turned $600 million into $4.3 billion, then slipped away before the fire. Did Buffett see cracks while everyone else saw an empire? The answer lies in the decisions made decades before the backlash. July 1989. Gillette's boardroom is under siege. Revlon and other rivals circle, eager to snap up the world's most profitable shaving business. Wall Street buzzes with takeover rumors, and the company's future hangs in the balance. Into this chaos steps Warren Buffett with a check for $600 million, one of the largest single bets of his career. But this is not just cash. It is convertible preferred stock, paying an 8.75% dividend and offering the right to swap into common shares at $50 apiece. The deal guarantees Gillette both immediate capital and a powerful ally. Buffett doesn't just buy shares, he takes a seat at the table, securing 11% of the company and a direct voice in its strategy. He writes to Berkshire Hathaway shareholders that Gillette is the kind of business he searches for, a brand so strong, with such repeat loyalty, that it can raise prices and still grow. In his own words, the best business employs capital at very high returns. He places Gillette alongside Coca-Cola in his pantheon of consumer giants, companies he expects to dominate their fields for a generation. At the time, Gillette controls around 60% of the world's razor and blade market. Its products are daily rituals for hundreds of millions. Buffett sees not just a product, but a habit. He calls Gillette's dominance a protective moat, a barrier of brand, shelf space, and customer routine that competitors cannot easily cross. The razor and blades model, selling affordable handles and locking in years of cartridge sales, turns every new customer into a steady stream of cash. His presence on the board is not passive. Buffett's reputation as a patient, discerning capital allocator sends a message. Gillette is no longer vulnerable. The market responds. Hostile bidders back off. The stock stabilizes. For the next decade, Gillette's board includes a director who measures every decision against long-term value, not just the next quarter's numbers. Buffett's thesis is simple. When you own a brand that is woven into daily life and you can keep competitors at bay, the math takes care of itself. The $600 million stake is more than a rescue. It is a declaration that some consumer franchises are as close to inevitable as business allows. The stage is set for Gillette's golden years, powered by innovation and the relentless compounding that Buffett prizes above all. Throughout the 1990s, Gillette became a case study in compounding power. Every few years, its engineering teams unveiled a new razor system, each one more advanced and more profitable than the last. The sensor, launched in 1990, set the tone, but it was the Mach 3 in 1998 that truly redefined the category. 3 blades, a sleeker handle, and a price tag that left competitors scrambling. Gillette did not just sell razors. Sold the promise of a closer shave and a better morning, one cartridge at a time. With each product cycle, Gillette exercised its pricing muscle. Cartridges routinely rose in price, often outpacing inflation, yet sales kept climbing. The razor and blades model locked in customers for years. Once someone bought into a Mach 3 handle, they were all but guaranteed to return for replacement cartridges, over and over. By the early 2000s, Gillette's share of the global wet shaving market hovered around 70%. In the US, the company was an institution, its products a fixture in bathrooms and drugstore aisles coast to coast. Inside Gillette's Boston headquarters, the next big leap was already underway. Engineers and marketers poured resources into Fusion, a 5-blade system designed to push the boundaries of comfort and performance. The project began in the early 2000s, with launch plans targeting the mid-decade. Fusion would become the most expensive shaving system Gillette had ever developed, but the company was betting that customers would pay for the upgrade, just as they had with Mach 3. The numbers spoke for themselves. Gillette's grooming division delivered some of the highest margins in consumer goods. The cash flow from razors and blades funded relentless research and development, global marketing, and a sales force that could outmuscle any challenger. Wall Street analysts praised the company's ability to turn innovation into market share, and then into profit. By 2005, Gillette's dominance looked unbreakable. The brand's global reach, pricing power, and habit-forming products made it the envy of the industry, and a magnet for acquisition offers. For Buffett, these were the golden years, a textbook example of patient capital compounding quietly, year after year, behind a moat that seemed as wide as ever. On January 28, 2005, Procter & Gamble announced it would acquire Gillette in an all-stock transaction valued at $57 billion. The deal sent shockwaves through the consumer goods world. For Warren Buffett, it was the moment his 16-year bet crystallized. Every Gillette share he owned converted into 0.975 shares of P&G, instantly transforming Berkshire Hathaway's $600 million stake from 1989 into P&G shares worth roughly $4.3 billion. That is a $3.7 billion profit, a compound annual growth rate of about 13%, the kind of return that turns a good investment into a legendary one. Wall Street cheered. The merger would create the world's largest consumer products company, combining Gillette's dominance in grooming with P and G's massive distribution and marketing reach. Gillette CEO James Kiltz, who had steered the company through its final years as an independent powerhouse, joined P&G's senior leadership. Buffett, ever the champion of strong management, called the deal a dream combination and praised Kiltz and the Gillette team for building a business with such enduring value. He did not cash out. Instead, he doubled down, buying additional P&G shares until Berkshire's position reached 100 million shares, valued at $5.8 billion. The mechanics were straightforward and staggering in scale. Each Gillette share became nearly one P&G share, and the combined company promised unmatched reach, from razors and shaving cream to laundry detergent and baby diapers. For investors, it looked like a marriage of titans. Buffett's board seat and public support signaled confidence. Analysts described the union as a fortress, two of the world's most trusted brands now under one roof. But beneath the celebration, a subtle handoff was taking place. With the merger, Buffett's direct exposure to Gillette's fortunes shifted to P&G's much broader portfolio. The risk of future disruption, new competitors, or changing consumer habits now sat with P&G's management. Berkshire's gain was locked in, and the risk had been transferred. On paper, it was a triumph, an exit that looked like a partnership and delivered a $3.7 billion win not by trading, but by patience and discipline. The story of Gillette as a standalone juggernaut was over. The next chapter would be written under P&G's flag, with new stewards, new strategies, and soon, new challenges. September 2008. Wall Street is in freefall. Lehman Brothers collapses, panic spreads, and Warren Buffett moves fast. Headlines announce Berkshire Hathaway's $5 billion lifeline to Goldman Sachs in the form of preferred shares, a 10% dividend, and warrants that could yield billions more. Weeks later, another $3 billion goes into General Electric, again on terms no ordinary investor could demand. Publicly, Buffett explains these deals as once-in-a-generation opportunities, funded by raising cash wherever he can. Quietly, Berkshire Hathaway's quarterly filings tell a different story. They show a steady reduction in Procter & Gamble shares, the legacy of that Gillette bet. From a peak of 100 million shares, Berkshire trims more than 16 million shares over the next 2 years. Nearly $1 billion is freed up, not by selling obscure holdings, but by tapping one of the largest, most liquid positions in the portfolio. The timing is not random. Selling a beloved consumer giant in the middle of a financial storm draws little attention. The world sees Buffett as the White Knight, supporting banks and industrial icons. Behind the scenes, he is using the crisis as cover to reallocate capital, shifting away from a business whose best years may be behind it. There is no press conference, no grand pronouncement. Just a line in an SEC filing, a few sentences in a shareholder letter. Liquidity raised, opportunities seized. The public narrative is all about saving the financial system. The portfolio tells a subtler story, one of discipline, not nostalgia. What is striking is what does not happen. After the crisis, as markets recover, Berkshire never rebuilds its Procter & Gamble position. The temporary cash raise becomes a permanent exit. By 2014, the remaining shares are swapped tax-free for Duracell, another consumer brand, but with a different risk profile. The Gillette story, for Buffett, is over. He is out of the razor business long before new competitors and cultural storms batter the brand. The lesson is not about predicting the future. It is about using moments of chaos to quietly step away from yesterday's winners. While most investors hold tight or panic sell, Buffett uses the world's distraction to make his exit, locking in decades of gains and sidestepping the pain that is still to come. For decades, Gillette's grip on the shaving world seemed unbreakable, but by the early 2010s, that certainty cracked. The first blow landed in March 2012 when Dollar Shave Club burst onto the scene with a $4,500 viral video. The pitch was blunt: forget expensive razors and endless trips to the store. Get quality blades shipped to your door for a few bucks a month. 12,000 orders poured in within the first 2 days. The video racked up more than 27 million views, and a new business model was born. Direct-to-consumer subscription razors weren't just a clever marketing trick. They rewrote the rules of the category. For generations, Gillette relied on the razor and blades system. Sell a handle cheap, then lock in years of high-margin cartridge sales. But Dollar Shave Club, and soon after Harry's, flipped that script. They cut out the middleman, undercut Gillette's prices, and delivered a simple, no-nonsense message: stop overpaying for shaving. The numbers told the story. By 2015, Dollar Shave Club had carved out about 8% of the U.S. men's razor and blade market, according to Nielsen-based reports. Harry's, founded in 2013, quickly followed, building its own factory in Germany and capturing a loyal online following. Industry data cited by the Wall Street Journal showed Gillette's global share sliding from around 70% at its peak to the mid-50s by the late 2010s. In the US, the decline was even sharper. What had been a near monopoly became a contested battleground. Revenue reflected the pain. Over a 3-year stretch in the mid-2010s, Gillette's grooming business saw sales drop by more than a quarter. Procter & Gamble responded with price cuts, up to 20% in some markets. But the slide continued. The old moat, built on brand, habit, and shelf space, was breached by new entrants who didn't need retail at all. Subscription boxes, viral videos, and direct shipping turned the category upside down. Inside Procter & Gamble, the alarms grew louder. The traditional playbook, innovate, raise prices, count on loyalty, no longer worked. Market share reports, once a source of pride, now tracked the slow erosion of dominance. The rise of beards and changing grooming habits added to the pressure. But it was the new business model, simple, cheap, direct, that exposed how vulnerable Gillette had become. The fortress Buffett once admired was under siege, and the attackers weren't playing by the old rules. July 30th, 2019. Procter & Gamble delivers a shock to Wall Street. $8 billion in write-downs hit the books, all tied to Gillette. The official explanation points to a strong dollar, fewer shaves, and relentless competition from upstart brands. But the timing is impossible to ignore, just 6 months after the We Believe campaign set social media on fire and sent loyal customers packing. The number is staggering. In a single accounting move, P&G admits that the Gillette franchise is worth billions less than what they paid for it. The goodwill, once anchored to decades of dominance and pricing power, is now a line item slashed by the realities of a changing market and a bruised brand. Executives field questions with careful language. The CFO stays on script, citing currency headwinds and changing grooming habits. But outside the conference call, the debate rages. Was this just the final reckoning for years of slow decline? Or did the ad accelerate the fall? Razor sales slipped from $6.5 billion to $6.2 billion in a year. Market share dips again, from 65% to 60%. The backlash is not just digital noise, it is a drag on real numbers. Gary Coombe, the man in charge of global grooming, steps into the spotlight. In an August interview, he defends the campaign and the $8 billion hit, calling it a price worth paying. He argues that Gillette had to risk alienating some customers to stay relevant with a new generation. Risk the minority to win the majority, he says. But the data tells a different story. 77% of viewers described the ad as hopeful, but only 34% said it made them want to buy. The campaign resonated most with women, 51% of the ad's engaged audience, yet men still made up nearly all razor purchases. The core customer, once fiercely loyal, now felt talked down to, not inspired. By December 2023, the pain deepens. Procter & Gamble records another $1.3 billion impairment against Gillette. The cumulative loss since the acquisition reaches $9.3 billion. Shareholders watch value slip away, not from a failed product launch or a supply chain disaster, but from a brand misstep and a bet on cultural relevance that never paid off. Through it all, Warren Buffett remains silent. No public criticism, no "I told you so." Years earlier, he had warned that lecturing customers is a dangerous game. Now his absence speaks louder than any quote. He had already left the table, leaving others to count the cost. Today, the difference between a gain of $3.7 billion and a loss of $9.3 billion is not just history, it is a living lesson. Markets punish nostalgia and reward discipline. As disruption accelerates across every industry, the cost of ignoring cracks grows steeper. Timing still separates legends from casualties. Which side you land on depends on what you see before the headlines hit. What would you have done? Share your thoughts below.